You know, financial reports can seem, well, pretty dry sometimes. But every now and then, you find one that tells a really fascinating story. And that's exactly what we've got today with CSC Holdings. They're a big deal in the foundation and engineering world, and their latest numbers for the first half of fiscal year 2026, they present a real puzzle, and we're going to solve it together.
And here it is, the big question at the heart of their report. How on earth can a company make more money, a lot more in fact, but end up with less profit? I mean, it just doesn't sound right, does it? But it's exactly what happened here. Let's break down how that's even possible.
Okay, let's look at the hard numbers, because this is where it gets wild. On one hand, their revenue, the total money coming in, shot up by over 26% to more than $195 million. I mean, that's fantastic, right? But then you look at the other number, the actual profit. That dropped, it plummeted by almost 54%. So way more sales, but a much, much smaller bottom line. What gives?
So, to get to the bottom of this, we're going to follow the money. First, we'll dig right into why that profit got squeezed so hard. Then, we'll do a quick financial health check on the company, kind of look under the hood. And finally, we're going to look at what they think is coming down the road.
All right, first things first. Where did all that potential profit just vanish? You see a huge jump in sales, you expect a huge jump in profit. That's just business 101. But that is not our story today. To find the answer, we've got to look a little closer at their costs.
Now, check this out. Just look at the relationship between the top two lines. Revenue up a very healthy 26.4%. But right below it, the cost of sales. That's basically what it costs them to actually do all that work. That number grew even faster, at over 29%. And that right there is the smoking gun. When your costs are growing faster than your sales, it puts a major squeeze on your gross profit. You can see it barely moved, up just 4.5%. This is the heart of our puzzle.
And you know what? We don't even have to guess why. The company comes right out and tells us in their report. The main culprit? They took on some big projects in Malaysia that just weren't as profitable as their usual work. Now, this could be a strategic move, right? Maybe they're trying to muscle into a new market. But for right now, it's definitely hitting their bottom line hard.
And this slide really puts it into perspective. Think about it this way. Last year, for every single dollar of work they did, CSC got to keep about 11.4 cents after their direct costs. Pretty good. This year, for that same dollar of work, they only kept 9.4 cents. Now, a 2-cent drop might not sound like a lot, right? But when you're talking about almost $200 million in sales, those 2 cents on every dollar add up to millions in lost profit. And boom, the first big piece of our puzzle is solved. So, that dip in profitability, that explains our mystery. But just because profits are down for a bit, does that mean the company's in trouble? Is its underlying financial health still strong? Let's zoom out and give it a quick health check.
And this is where the story starts to look a lot better. Despite that profit squeeze we just talked about, the company's core business is still a cash-generating machine. They actually brought in almost $19 million in cold, hard cash. This is a super important number because it shows that even if the profit margins on some jobs are tight, the fundamental business of doing the work and getting paid for it is still very, very healthy.
Okay, to understand this next point, we need a quick definition. A company is in what's called a net current liabilities position when basically the bills it has to pay within the next year are bigger than the cash and other stuff it has on hand that can be quickly turned into cash. It can be a sign of a little short-term financial pressure.
And yep, as of the end of September, CSC was in this position by about $4.5 million. So what does that mean in plain English? Their short-term bills were just a bit higher than their short-term assets. For anyone watching the company, this is kind of a yellow flag. Not a red one, but it definitely makes you ask, okay, how are they going to cover all their bills in the short term?
So how are they planning to handle it? Well, they've laid out a very clear two-part answer. First, they've got $30 million in credit they haven't even touched yet that they can tap into. And second, they expect cash to just keep flowing in from their business, just like we saw a minute ago. So while it's a situation you've got to keep an eye on, it looks like they have the resources to manage it just fine.
Okay, so that covers what happened over the last 6 months. But in business and investing, it's always about what's coming next, right? So let's look ahead. What does the future hold for CSC?
Looking forward, this is probably the most important number on the screen, $270 million. That's the size of their order book. Basically, it's the total value of all the confirmed projects they have lined up and ready to go. This is a fantastic sign. It gives them a really clear runway for future revenue and shows that demand for their work is super strong.
And it really seems like the wind is at their back. The company points to some really powerful trends happening in its main market, Singapore. You've got massive government spending on big infrastructure projects, a huge expansion of the rail network, a big push for more public housing, and all this foreign investment pouring into high-tech facilities. All of this creates a ton of demand for exactly the kind of specialized work that CSC does.
And they're not just sitting around waiting for the phone to ring, they're making some smart, strategic moves. One really interesting one is this new service center they're setting up with some Chinese partners. See, there's more and more Chinese-made construction gear being used in the region, and this center will be there to service all of it. That's a clever way to create a whole new revenue stream for the company.
So let's bring it all together. What's the big takeaway from all this? The answer to our puzzle is that CSC is deep in a phase of aggressive growth. This wasn't an accident, it was a choice. They went out and successfully won a whole lot more work. But some of that work, especially in Malaysia, just came with thinner profit margins. It's a classic business trade-off. Go for market share today, even if it costs you a little bit in short-term profit.
And that leaves us with a big question going forward. They've absolutely proven they can win new business. That $270 million order book is all the proof you need. The market conditions look great. So the real challenge now is to make all that future growth more profitable. Can they manage their costs better? Can they be a little more selective with the projects they take on? Turning that massive pile of work into an even bigger pile of profits, that's their next big test. And it's the story we'll all be watching.